Hello and welcome to your CIMA F1 Financial Operations, the chapter on construction contracts. IAS 11, which covers construction contracts, refers to situations where a contract exists. That's very, very important, and that specific contract, which has a value, a timing agreed between the parties, between the construction company and the beneficiary, that particular contract should refer to the construction of an asset or a combination of an asset. What do we mean by that? For instance, if you want to build, let's say, the English Channel, just to give you a grand example, or if it is to build a railway, such projects would need a contract, and such projects most likely will straddle more accounting periods. So this particular contract would fall under IAS 11. IAS 11 does not cover any form of contracts of services. So they have to be geared towards constructing an asset or a combination of assets. And what's the ultimate spirit and purpose of IAS 11? Is to make sure we are not recording profits on such contracts by anticipating them, but rather relate them to the accounting period to which they relate. And again, they are not anticipated, recorded earlier than they are effectively earned. And as well as exercising prudence, you are recording losses as you notice they hit the project. Because as you can imagine with these large projects, which go over 2-3 years' time, your initial estimations and costs many times can be overridden due to unexpected factors and so on, and such particular projects like English Channel, for instance, escalated into fees to a larger extent. So what you want to see is every year in your accounts is, in case you are anticipating a loss, as at today in your accounting period, you are reflecting that loss immediately. Alright, this being said, that's the spirit of the standard, and I have to say there is my favorite diagram coming over, which personally I think will help you to deal with any questions you may get on IAS 11 construction contracts. So have a look at this diagram, which is in your express notes, which I assume you all downloaded from our website next to our recordings, and let's go through it briefly. So what's the first question you're gonna ask? Really, if you follow these steps, you'll be safe in any type of question. Is the contract for markup or for fixed price? Of course, this information will be given to you in the question in the exam. If it's markup, I hope all of you know what markup is. It's a percentage applied to cost. Life is great because it's very easy on a year-by-year basis based on the costs incurred. So you reflect the cost you incurred to date, and to that you calculate the percentage markup, and that is the profit you recognize for the period. So it's very, very specific which portion of profit is justified to be reflected in the current period for which you are preparing accounts for. Exactly the proportion related to the costs you recognized in that period. So I would say this part would be very easy. However, as you may expect, most likely you'll have a fixed price sort of contract. So what do you do then? If it's a fixed price contract, then you have to challenge the whole information with the following question. Is the contract expected to make a profit? Well, let's say it's no longer expected to make a profit. So what do we do then? If you remember what we said earlier, you have to recognize the expected loss in full when apparent. So what you're going to have to do is to say, okay, I'm taking my total revenues to date less consolidated or aggregated cost to date, and see what sort of profit or loss you are. And if you're in a loss, you immediately reflect that into your current year statement of comprehensive income. However, if you are on the good side, on the good news side, and you are recording a profit rather than a loss as at that point in time, the next question you're going to have to ask about this particular profit is, how certain is that how certain is it for us to record the profit as a construction company? So is the outcome of the contract reasonably certain? Well, let's say maybe it's not, because certain legislation could come in force you didn't know at the time you negotiated the contract, various unexpected events to slow you down, maybe some strikes and so on. You may believe they happen, let's say, but you don't know for sure, so you wouldn't feel that sure about the profit. So what you do next? Well, all you're doing, given the high level of uncertainty, and we have to be prudent, is to match revenues to equal cost to show no profit or no loss. So all you're saying is, okay, I have incurred cost to date of X. I'm going to come and record revenues exactly in that level so that the net effect of the two will be nil in the bottom line, in the statement of comprehensive income. However, if you're still on the good news and you're going to record a profit and that is reasonably certain, that's where you want to be, then what you have to do in order to create that matching and recognizing the related appropriate profit for each accounting period without anticipating such figures is to recognize attributable profit as it's earned based on a percentage completion. So how do we calculate this percentage completion? And on the next page you have the two options, one of them being more popular with your examiner. So according to IAS 11, you can calculate that degree of completion that will help you to determine how much profit to recognize. You will recognize it in relation to the degree of completion of the project in two ways. The first way is to say, okay, I'm going to take the work certified. So how much have we completed based on work certified? And who's going to tell us the work certified? Well, you basically need to hire an independent expert. That would be very, very common. And in the exam, you will be provided that information. How much work is certified to date? And the total expected revenue you would have to calculate based on the information provided. So when you put those two together, you get a percentage. Let's say work certified relative to total expected revenue, 20% as of today, and you have 80% remaining in terms of work to be done. What do you do as of today within the current accounting period? When you prepare financial statements, you're going to take 20%. You would be entitled, or you'd expect to justify 20% of the overall profit of the contract. Remember, going through the logical questions we covered earlier, and assuming is reliable, 20% would go in statement of comprehensive income. Another way to calculate the degree of the percentage of completion would be cost incurred relative to total expected cost. As you can imagine here, having an expected cost figure, that's a bit of an approximation. You could argue this is not that accurate, and especially that the examiner will use the first option, mainly the work certified relative to total expected revenue in your exam. You better be very, very familiar with that. Okay, of course you can read the steps here, which pretty much reflect the diagram you've seen on the previous page in your own time. And one final point I would like to say here is everything we touched upon in terms of highlights were pretty much related to your statement of comprehensive income. What I would like to touch upon is what happens in our statement of financial position. What do we have there? So what you will have to calculate as a special working, and totally recommended to use this particular working, is the gross amounts due from or due to customers. So when there are gross amounts due from customers, I'll go through how we calculate that. Due from customers means you have a receivable in the top part of your statement of financial position. If you end up with gross amounts due to customers, I guess you can say they would be liabilities in the bottom half of your statement of financial position. How do we calculate these gross amounts due from or to customers? Well, you have to take your costs incurred to date, which of course they will be mainly given into your question. The recognized profits, which you calculate based on knowledge we covered in terms of almost like highlights earlier on, the recognized profits based on degree of completion. Then you may have some recognized losses to date, and you would take those out, and you would compare these figures of the cost plus profit less recognized losses to the value, the amounts that you already billed or invoiced to your clients. And if you imagine this, if you invoiced more than you should have invoiced, and you should have invoiced this, the result of these 3 lines, isn't it? If you billed more, then the difference would be a liability. If you billed less than you should have billed, than you should have invoiced, then you should obviously have a receivable for the difference. You would expect, even if it's not billed, that in its nature it's a receivable, so it would be a plus, would be in the top part of the statement of financial position. These are really the highlights of your construction contracts, but really you don't need more than this logical structure you had to be successful in various questions. The questions will not intake lots of marks, maybe 5, maybe 7 marks, but you want to make sure you follow the logical steps from the pages we covered earlier, from page 17, for instance, and the degree of completion from page 18. This being said, best of luck with your preparation with construction contracts, but all the other areas that are fully examinable for your syllabus in CIMA F1, and look forward to being in touch with you for the next videos. All the